we'll put information for you in the chat box as well, and you can use the chat to talk to each other. So let's kick off. Really, as members of the public, there's lots of things that we can do about climate change through individual action. So we're all aware we can eat less meat, fly less, drive less, use less energy. But most of us don't know that perhaps the most powerful action we can take is to decarbonise our KiwiSaver or our investment fund. So we're going to slide that shows this, just coming up now. So the slide shows on the left-hand side the footprint of the average person through their KiwiSaver fund. And that's 3.4 tonnes of CO2 equivalent, greenhouse gases, essentially. On the right-hand side, we've got all the other aspects of our footprint, the food that we eat, the electricity that we use, our travel, our shopping, etc. And that's about 6 tonnes of CO2 equivalent. So, what this shows is that it's very significant what you emit through your investment funds. Not all of it's immediately going to go away by changing a fund or changing a policy of a fund, but you can significantly influence that output from your investments. And that's what we're going to talk about tonight. We're going to talk about how to do that, and we're going to talk about the different strategies that the fund managers can use in order to make that happen. So in our second slide, and we've only got 2 of them, we're going to talk about the strategies for doing this. The first one on the left-hand side is portfolio construction. So this is the stuff that you invest in. And the stuff that you invest in can make a difference. You can avoid fossil fuel production or power generation using fossil fuels. You can avoid high emissions companies, or you can switch to lower emissions companies. So that's the first thing, what you invest in. The second one is kind of what you do through your investment manager with the investments that you have. And there you can do things like engage with companies to reduce their emissions. You can vote on resolutions or AGMs. You can kick off directors who don't get it on climate change. And you can catalyze kind of wider action to force the companies to reduce their emissions. And the third one on the right-hand side is you can invest in climate solutions. Classically, you can invest in clean energy or EVs or other zero emissions options, and invest in carbon sequestration. So those are the 3 strategies we're going to talk about in tonight's seminar. So as I say, we've got a great panel ahead of us, and it's my great pleasure to welcome Niamh O'Flynn, who's somebody I've worked with for a long time and have huge amount of respect for. Welcome to Niamh. Niamh is Program Director at Greenpeace New Zealand. She's former Executive Director of 350 Aotearoa. She headed 350 Aotearoa when they were running divestment campaigns, including councils and universities across Aotearoa. So Niamh's going to kick off with a kind of relatively simple question. Why do you think it's important to get fossil fuels out of KiwiSaver and investment funds?
Thanks, Barry. Tēnā koutou. Thanks for having me here. I want to just start by stressing the seriousness of the climate change issue and the role that the financial sector has to play in it. We're on the verge of climate collapse, and for decades, governments and corporations have had the chance to mitigate the problem and have really squandered that chance. And we're really at the cusp of crossing planetary boundaries that hold our whole natural system in check. And we're still not seeing the climate action that we need to see from our leaders or our business leaders. And obviously, the financial system is operating at the heart of the economy, so it's an extremely crucial role to play in the fight against climate change. But historically, it's been regarded as separate from society and not bound to the same limits of the environment that actually sustains it. And it usually divides it divides kind of financial decisions into risks and returns and doesn't really take into consideration the consequences of the financial decisions. An example of that, as you mentioned, Barry, when I was campaigning on banks and fossil fuels, ANZ as a business reported being carbon neutral for the last 10 years, but enabled about 2.8 billion tons of CO2 across seven new fossil fuel projects between 2015 and 2020. So as you can see, how you kind of view your emissions and what you're enabling in the world can be quite different in the financial sector. We know that the fossil fuel industry is one of the industries most responsible for climate pollution on Earth, for over 70% of global emissions, and it's still expanding. So the implications of investing in the fossil fuel sector are twofold in my view. One is obviously every time you're investing in the fossil fuel industry, you're effectively endorsing it. And Bill McCabe famously said, if it's wrong to wreck the planet, then it's wrong to profit from the wreckage. And the other side of that is that when you're investing in the fossil fuel industry, you're enabling access to capital for that industry to operate and continue to expand when we know it has to stop.
Yeah.
And I would say that the sector has the mandate to act on climate change. Everyone around the world is demanding action on climate change. We've seen $15 trillion committed to divestment from the fossil fuel sector. That whole international divestment campaign has shaken the market, and we're seeing a lot less capital accessible to the fossil fuel industry, but that work still isn't done. So we need the finance sector basically to take huge action very quickly in minimizing in enabling the energy transition. So what I would really want to see is the financial industry standing together to divest portfolios from the fossil fuel sector, exclude them, spend time engaging with other industries that are able to do better, and then rapidly invest in the renewable energy sector. We know that we need between 3 and 5 trillion a year to keep global temperature rises beneath 1.5 degrees invested in renewable energy. So it's a lot of money, and it's a transition that we need to see really quickly. So I'd like to see our money doing good.
Yeah, it's a lot of money, but on the other hand, the financial flows are absolutely huge. As you said, $15 trillion in portfolios that have divested from fossil fuels. So, Niamh, Mindful Money did some sums and said there's about $1.5 billion being invested in fossil fuels through KiwiSaver funds alone, let alone other investment funds. Why do you think people keep on investing in fossil fuels, even though surveys say that most people don't want to?
I think it's a lot of business as usual, and people thinking in this old mindset that this is the way that we have to do things. And you still see the financial sector talking about having balanced portfolios, even when the fossil fuel sector isn't giving them returns. And I think it's just a really old school way of thinking, and we need to get up to play with where the world's at.
Cool. Let's come back to some of these issues in discussion because this kind of really strikes a chord from our experience with members of the public who think really about taking action on climate change through getting out of fossil fuels. But I want to sort of open it up because there are other ways that people can act. And I want to turn to introduce Ronan McCabe. So Ronan is the Chief Investment Officer for Mercer New Zealand Investments, temporarily based in Sydney. That's tough. You haven't been able to get over here, Ronan. I'm very sorry about that, but you're in less of a lockdown than we are at the moment, so maybe it's not so bad. Ronan was previously a lecturer at Trinity College in Dublin, and he's been an investment manager for the Ireland Strategic Investment Fund. So very warm welcome to you, Ronan.
Thank you, Barry.
Ronan, Mercer plays a number of different roles in climate change, quite a few hats across advice and managing the managers and managing funds and so on. Can you describe how important climate change is to Mercer's work?
Yeah, so for well over a decade now, Mercer, has been saying we believe that climate change is a systemic risk, and as such, it should be addressed in portfolios. And I fully advocate and agree with everything Niamh just spoke about. ultimately, managing money and managing investments is about risk management. So while on one hand, no one denies obviously climate change and what it does in portfolio, with a fiduciary hat on, managing people's money and people's KiwiSaver absolutely should be taking climate change into account. So how we think about it is we think about, as we transition to a lower carbon world, and it's very much that idea of the word transition, it is trying to build portfolios and manage money through transition through to a lower carbon world. The way we think about it in our portfolios, at a very blunt instrument level, we do look at the carbon footprint of all our portfolios on an absolute basis, but also relative to different benchmarks. And thankfully, we're generally much lower carbon footprint than our benchmarks. But it's also how we think about transitioning through to 2050, but also shorter term over the interim over the next 9 years to 2030. And what I mean by that transition is, I think about it this way, is if you have two companies, Company A and Company B, and as of today, Company A has a higher carbon footprint than Company B, but the management of Company A have come out and have committed as a business that they will transition to a lower carbon world, to a lower carbon footprint in their business over the next 10 years. Well, if you have to make a choice between Company A and Company B, while on the face of it, you might think Company A is you don't invest in it because of carbon footprint. But if you invest in carbon A versus B, you will transition to a lower carbon world. And as we do transition to a lower carbon world, certain companies will need either debt or equity financing. There obviously is a certain cohort of companies that will have stranded assets. They'll be reflected in valuations. And that's all part of how we think about building our portfolios and the managers we engage in.
So I sort of get it with the idea of saying that you can work with the companies that will reduce their emissions. Can you give some more detail about how you engage with them, what you do in order to persuade them to reduce their emissions faster, or help them do it, or what's the process that you use?
So sometimes we're for the most part, we're a manager of managers. So we hire underlying investment managers. But generally, how we do it is we engage someone directly with the companies, or else we engage with the managers that we hire. And through those conversations, so for example, we vote on every single stock we hold. So for example, in our New Zealand portfolios last year, we voted on close to 3,000 different AGM and shareholder resolutions across a range of different topics, including environmental and climate change issues. So we put the onus somewhat back on the managers and how they think about engaging with and the companies underlying in their portfolios. So the sort of conversations we have with them is, it's different topics around why are they holding certain companies. Again, the idea that Company A, Company B example, if they're holding a particular company in their portfolios that has a very high carbon footprint with very low probability of being able to transition to a low carbon world, we know that this is going to be a stranded asset. So the rationale we say is, why are you holding this? This just makes no sense on a risk and return perspective. Why you want to hold that? The way and we prefer engagement over divestment. There's a time and place for divestment or exclusions, but the way we think about it is divesting or excluding explicitly from our portfolios it's like throwing the rubbish over your neighbour's wall. The rubbish is gone from your garden, but still there, albeit your neighbour has it. So we think it's more around true engagement, true thinking properly and doing the analytics on your portfolios and thinking about how we move through transition, not just over the next 3 decades, but more urgently over the next 9 to 10 years.
Yeah. But as you say, if a company isn't going to play ball and if they are not going to change, then you do go ahead and divest from those companies. You exclude them from your portfolios.
It's divesting more from, not from an exclusion perspective per se, it's divesting from an investment perspective. It makes no sense why you want to hold them in your portfolios if they're not addressing, what is, as you say, probably the biggest systemic risk facing humanity.
So have you got any kind of good examples that you can use to illustrate this? Something that kind of maybe the public can understand via a case study, if you're able to talk about it without breaching confidentiality?
Yeah, sure. So it's interesting there talking about the financing and the banking side of things. So one of the managers we engage with They forced, or they speak to a lot of the underlying companies in the financial services sectors. And one of the metrics and triggers they look for is getting the banks to stop financing fossil fuels. So as part of our conversations, our engagements with those managers indirectly through those banks, we're making sure that those underlying companies are not financing fossil fuels, or else have a strategy to stop financing some of those fossil fuels activities going forward. Closer to home, something like Freightways, maybe in New Zealand, where we've seen managers increase portfolio weights in certain stocks because just that particular company maybe has improved efficiency in how it's running its business. So we've seen managers weigh things like this, where we think of something like listed infrastructure. So as asset class investments go, listed infrastructure is probably the most carbon intensive from a footprint perspective. Now, there's still a role to play because we do need infrastructure around the world. So how we, with our managers, is where we survey our managers and make sure that they're, moving out of certain sectors, oil-intensive sectors, and into more renewable energy sectors, into green energy sectors, into sectors with maybe data centers. So as we move into climate change, a lower carbon world, things like technology is more of an issue, and less around the gas and pipeline side of things. But it is fair to say at the same time is that certain sectors will need that certain amount of financing if they are to transition to a low carbon world.
And just a quick final question. It's obviously kind of gives you more power when you're able to act in concert with others. Are there kind of forums where you can gang up on large companies that aren't playing ball and that are not making the climate transition?
Yeah, I wouldn't maybe say, I wouldn't say gang up, but I get what you're saying. Yeah, there are a number of different forums and groups that Mercer in New Zealand are part of right around the world. So Mercer as an entity where we manage close to 11 billion New Zealand dollars in New Zealand, but more broadly we manage close to 400 billion US dollars right around the world. We advise on just shy of, we advise on 3 trillion US dollars right around the world. Sustainable investment is a core part of what we do. So the types of collaboration we're part, both in terms of dealing with and speaking with other asset owners, asset managers from around the world. So groups such as Climate Action 100, Investor Group of Climate Change. These are kind of some forums, but there's many, many different types of groups and forums right around the world. In many instances, the ability to kind of bring that weight of capital and influence that we have, use that in collaboration with other entities, other large asset owners from around the world, whether it be sovereign wealth funds or similar peers and competitors to ourselves. When you bring that to force, it's actually quite a huge weight and influence you can bring to the wider investment financial sector.
Good, thank you very much. Let's come back to some of these issues in discussion when we come to the panel. But just to bring in the final speaker, Dean. Dean Anderson's the founder and CEO of Kernel Wealth. Kernel's a new and innovative fund. They're a provider of retail investment funds. Dean's experience includes development of exchange-traded funds at SmartShares, and he did data licensing at the New Zealand Exchange, NZX. So very warm welcome to you, Dean. Thank you for joining us. Hey, so can you kick us off? So Kernel offers index funds of different varieties. Can you tell the audience what that means and how that can potentially relate to climate-friendly funds?
Yeah, so in a nutshell, an index fund is a broad basket of companies, and rather than making individual stock selections, we are out there replicating an index, and an index has often been a measure of a part of the market. They've been around for a number of years and often been quite disrupted. The benefit of index funds is that it's data-driven and lowering costs. One of the really interesting things about this climate transition, this tipping point that we're at, is the role of data and technology. And now, just the last 3 years, we've been able to do a significantly larger amount of measurement and reporting through data, and therefore create indices, benchmarks or index funds that capture non-financial metrics. And that's a really interesting stepping stone where all of a sudden we're not just looking at the financial elements, we can incorporate non-financial metrics such as carbon, governance, social impact, water usage within an index fund, making that lower fee and more accessible to everyday investors. It also means that we can establish benchmarks for us as other investors or direct stock investors to be out there and looking at what role our portfolio has in the transition to a lower carbon economy.
So I'm aware there's now one or two kind of wholesale funds around for climate solutions, like the new climate venture capital fund that's raising money at the moment, and a few others. But is it the case that you're offering really the first retail funds for climate solutions?
I think we've definitely had a lot of focus on forward looking at where we're going. And I guess in a nutshell with Kernel's journey, when we launched just 2 years ago, it wasn't possible to do the things that our speakers tonight had talked about, going beyond just exclusions. A couple of years ago in New Zealand, it wasn't possible to develop an index fund that did more than just say, we don't want to invest in gambling. It's only now we're at the point where we've got the data to actually be able to measure companies, calculate their emissions and other elements that we can create an index fund on that. And that only happened this year. And so we were proud to launch New Zealand's first ESG index fund. And we've also developed a range of thematic funds that was sort of, I guess, very sector focused and forward looking around clean energy exposure, electric vehicles and renewable transportation. And so there are a number of new initiatives happening around the world where we're developing new product solutions that can really enable investors to back and be aligned to where we want to be going from a global and societal perspective.
So trace us through it. So if somebody goes ahead and invests, for example, in a clean energy fund, to what extent does that actually result in more clean energy versus displacing somebody else's investment?
I think that's the great point of it, right? I think people have to understand that when they go and put their money into a fund, they're not giving money to a company. I actually think that's a common misunderstanding in reality. They're buying shares of somebody else. But what it does enable is how you're controlling the capital that may be accessible to those companies in the future. And as Ronan and others have discussed, the engagement. And the engagement piece is quite an important piece, as well as just trying to signal change. And the flow of assets generally is quite a powerful beast. Financial services make up 20-25% of the global economy. This is a big lever in pulling a shift towards a renewable future. Engagement, and that can be done through managers like ourselves voting, and Ronan has talked about, is a key one. And that actually, I think, a couple of elements that come into that, and examples, I guess, are relevant. One is the Nun Society. I don't know if you've followed that with their voting within armaments. And to Ronan's point around, divestment versus engagement and realizing we're in a transition and, we can't just always exclude. You should go and have a look at some of the Nun Societies in the US, where they took a shareholding within Smith & Wesson and put resolutions to the board and force them to consider the role that their armaments were having on society. That is a good example where actually creating engagement and having an impact can flow through. Another really interesting development just this month was BlackRock, one of the biggest fund managers in the world, have just opened up, and next year they're planning to open up voting by end investors. So if you think about, if you invest in a KiwiSaver at the moment, or you invest in a Kernel fund, we can vote and engage the board of the companies that we're invested into directly. That is often done with, the mindset of the collective pool of people. They're opening that up to be engaged by the end investor. I think what's really interesting, will be interesting to watch on that front, is that I suspect day to day, very little is going to come of that. But what will happen is that you will see very big retail rallying around issues that get flagged in the media. And we've seen that happen before just generally, but all of a sudden the end investors are going to have quite a large voice in being able to direct companies and where they expect them to be going from a societal and environmental position. So there's some really interesting dynamics happening.
Cool. Great. So let's invite everyone into the panel, and Niamh and Ronan, if you can rejoin us. Cool. So these are three strategies we've talked about, and we've talked about sort of maybe this one, not that one. To what extent do you think that they're compatible? Because we did our awards for first awards for kind of ethical investment awards this year, and what really struck me was the funds who are using each of these strategies in a complementary way. Do you agree with that? How do you see that working? How do these three strategies work together?
Can I give I'll give an example there. We've talked about divestment, we've talked about engagement, and we've talked about sort of thematics and going deep into a strategy or alignment with your values, right? And I think they all work together. NZSE, we've got specific solutions to deal with cultural issues in New Zealand, particularly concerns around gambling. There is no way around that. They just do not want to be associated with that. Then, in addition to that process within an investment strategy is the screening and the tilting and the engagement. And then investors can also complement that, and so increasingly we're seeing people wanting to go deeper green or enhance a portfolio by, say, looking at a sort of thematic strategy. So they all work together, and I guess what's nice about that is that you've got a range of solutions out there now that you as an investor can align around your own personal views and how much you are conscious of these decisions and where you want to be having an impact.
Okay.
Yeah, I'd maybe kind of add to that, and like there is a time and place for divestment. So if there's, again, the idea that if there's certain companies out there that by the nature of their business model or management have come out and said that, they will not look to kind of transition to low carbon or can't, maybe, there's a reason that from if you want to bring it right back down to a fiduciary responsibility, why would you hold that in your portfolio? It's not going to make sense. Where the engagement is interesting is, if we take the example of ExxonMobil in the last 4 or 5 months. ExxonMobil now have three, the media says climate change activists, but climate change aware directors on the board now, and they're looking to change their philosophy and policy of how they're addressing climate change and a wider business model going forward. So on the one hand of it, and they're still very early in their journey. On the one hand, you can think about divesting, or on the other hand, you can think of kind of working with an organization like that to transition into a lower carbon world. If I use another example like Ørsted in Denmark, Ørsted are now I think the largest owner of wind renewable energy in the world. Ørsted started out as a company called Dong, which was set up by the Danish government in the 1970s, with the idea that they were 100% fossil fuels, taking natural gas and selling that and processing that from the North Sea basins off the coast of Scandinavia. About 15 years ago, they had a turnabout, and they sold down all their fossil fuel assets, and they've transitioned completely into a 100% renewable energy utility company. Again, in order to do that, though, they needed to kind of access the debt and equity markets quite well. So you weigh it up. There is a time and place for divestment, but where it makes sense as we transition to this lower carbon world, there is a case where engaging with the companies, but also thinking about what's in the portfolio. It's a balance. It's a tough situation we're in, and it's a case of trying to kind of balance up these different views.
So Niamh, Ørsted's one example, and that's kind of how it's meant to happen. They're meant to go quickly from being fossil fuel producer to renewable energy producer, but in a way, they are just such an outlier in the fossil fuel industry. Do you see this transitioning happening fast enough? And how do you see the responsibilities of the investment community in doing these things to basically accelerate that process?
Yeah, thanks. I entirely agree that a diversity of strategies is very necessary, but I would say that engagement with some industries is too slow to meet the needs. And and to meet the science, actually. And the fossil fuel industry, I would say, is an entire industry that the financial sector could look at and say, look, these people aren't transitioning. They're not going to transition. We actually just need to exclude them because at this point, they are literally wrecking the planet. And, you know, very, very fractional parts of these businesses are doing anything. And actually what we know about the oil industry is they're not transitioning when they're moving out of oil, they're not transitioning to renewables, they're transitioning into plastics. So they're finding other ways to prop up their business model. And they've had engagement from people all across the world for the last 30 years on this issue. And so I would just really question whether or not funds and people who are able to engage with the industry are seeing the success that they think is necessary, because I don't think it's anywhere near fast enough.
Can I just say that I think that's where technology and announcements and new innovation technology and even announcements by institutions like BlackRock are really interesting, because I think you're right. I don't think proxy voting and fund manager level voting often goes far enough on the basis that, you know, they're ultimately representing a very broad group of people. They're probably going to lean towards a more conservative bias there. Direct retail engagement, and we've seen what's happened by retail investors just over the last 18 months who have become invigorated and engaged with financial markets. As consumers of products and now being equally engaged within the financial markets can have a serious impact. And I think if voting gets put into their hands and they start to rally around causes, we will start to see a faster impact through engagement. Thanks to the, I guess, energy and collective power of the retail investors. So I think that's going to be really interesting to watch over the next 12 months.
I think we can all sort of agree with COP26 coming up that it's not happening fast enough. We've got a question coming from Patrick. Thanks very much, Patrick. Patrick's saying, I really struggle to believe that a company like Exxon is capable of transitioning. It seems that there's a big issue around greenwashing. Can the panel speak to the level of sophistication that exists within the market to identify greenwashing and be aware of it? So many people may know that Exxon got ambushed at their last AGM, and 3 directors were replaced from their board by some of the large shareholders who had become much more active. So what do you think about this sort of level of greenwashing around companies saying that they're doing things but actually not really doing it? How do you kind of set the metrics to be able to be sure that really change is really happening?
So I think Exxon is actually a great example. So with Exxon, what happened there was that the particular investment manager who got the 3 directors on the board sought to engage with the company directly. The management of the company had zero interest in that. So that investment manager then rounded up a number of the largest investment managers around the world who held sizable voting shares in Exxon, and rallied up a group and effectively got 3 climate-aware directors onto the board. So that then now means that Exxon now have to rethink their strategy, and we'll see what happens with that in the future. And if they don't, then we've seen already how their share price has dropped over the last 5-10 years. They've dropped out of the top 10 by market cap. So we'll see what happens with that. What's interesting with that story is it's not so much about Exxon, is how there's been a knock-on effect to a lot of other companies that are actually engaging with similar investment managers now on the back of, oh my God, we didn't do anything, we got bad press out of this, in the Exxon example, and are actually now willing to engage more with underlying investment managers. I would say though broadly, yeah, there is definitely an element of greenwashing in the industry, and it is something that we've seen regulators from around the world, and in particular in New Zealand, being much more aware and much more conscious of this. It is tough, no doubt about it, for investors and for retail investors to how do you know if you're the person or the company or the organization managing your money is greenwashing or not. So obviously the regulatory environment needs to change to kind of really prevent that, to protect retail investors, and you will see more and more of that going forward. What's going on in Europe around regulation is a really good example of where that would go to protect end investors around ESG and greenwashing credentials around that. The questions I'd be asking of your investment managers is really kind of trying to dig deep around evidence that they're actually engaging with their with either the managers or the underlying companies. A lot of this should be made available around what an investment manager's ESG or responsible or sustainable investment policy is, what sort of reports they do, and they should be able to publish under TCFD, their climate change statement. They should also be publishing what a highlights report of what they're doing on an annual basis with your money, and different things. So these are sort of questions investors should look to actually stop greenwashing, because I'd agree with Niamh's point. There is the investment community and finance community needs to do a lot more. There is a huge swathe of the investment community doing a huge amount around this, but there is also quite a lot of the investment community where it's sitting on its hands, and there's a bit of hubris around it, and it's not a case of climate change is happening as it is, and it's not being something down the road. This needs to be addressed right now. And what's interesting is coming into COP26 in the next couple of weeks, for the first time of any of the COPs in the last 26 years, this particular COP in Glasgow in a couple of weeks' time is putting finance and the onus of finance front and centre of trying to address climate change. And that shows the importance of what this particular topic is for the finance industry.
Yeah, it is something that Mindful Money is very well aware of. We set up Mindful Money partly to cut through greenwash by telling people what actually they're investing in terms of companies. So there's an ultimate objective truth to say, so where's your money going? So, but I think governments do need to step in and step up to this, and we're a long way from the government regulation that is able to tackle greenwash yet. I think. Niamh, do you have any comment on your perception from you've been at 350, you're now at Greenpeace. How do activists, for example, see the investment community around these issues?
I would say there's fairly low trust that that the investment community has had to be dragged kicking and screaming to reach this point where we're in 2021, and it's been a huge body of campaigning work from people all across the globe to get the financial community to recognize climate change first as a risk, but then as a bad investment. And I would just also say, yes, potentially, there is that engagement piece, but strategically there are so many industries that could be doing a lot better, that are very big polluters out there too, and I presume that fund managers only have so much time as do activists, and picking the ones who can actually and are willing to make change seems like a much better place to spend engagement time, because I think you said, Ronan, we can look and see in the next few years where Exxon ends up with that, and to me that's been happening for the last 30 years, and I don't see what would be different in the next 5 to make that difference. And by the time we're there to see, it's actually too late. So I think we need to be quite pragmatic about an industry that has basically manufactured the science to deny climate change, and wonder why they're suddenly listening to us.
Yeah. Dean, just to come to Dean, you're using data in innovative ways. Do you see kind of ways in which there can be some real cut through in order to accelerate change through the use of investment?
I guess I have a very optimistic outlook on life. And I often talk about these forces coming together, and we're at this moment where we haven't had all 3 forces coming together at once. And so we are having regulatory weight come in from TCFD, from things like default KiwiSaver changes, significant consumer demand. There is no denying the consumer demand element there. And now we've also got the ability to actually measure and report on these things. We can actually get granular insights around carbon emissions, company footprints, reporting on governance frameworks. The data, the insights, the consumer demand and regulatory pressures are all converging. And that's actually relatively new. It's only in the last few years that that's really all come together. And that is going to start driving that change. And I think these things often feel like they can be very slow. Disruptive change can feel like it's very slow, and then all of a sudden it's not. And I often look at things like the EV sector. Just think about what has happened and take a moment to really step back and look at that from the outside. Yes, it's still got a long way to go. But 10 years ago, if you thought about shifting to a renewable transportation future, you would have imagined a highway full of Priuses. And nobody would have perceived that, that's where we're going or wanting to go down that pathway. Think in the last 2 years, every leading manufacturer has either announced or rolled out an EV line. The biggest selling car in Europe now is an electric vehicle. Just last month in New Zealand, the number one selling car was a Tesla Model 3, pipping the Hilux. We are seeing consumer demand and the products. And I think what's really interesting here from the financial services point of view, Barry, you mentioned it very early. It's very easy to respond to surveys. The reality is most people aren't that engaged or that have that much activism motivation within them to create change. They're very busy in their day-to-day lives, and COVID's been very draining. If you get presented with a survey saying, are you going to invest ethically or interested in sustainable solutions? You're always going to say yes, because you jump to the conclusion that the alternative is no, and of course I'm not that. But then where do you actually spend the money? I think the EV is a good analogy of what's happening with financial services. In the last couple of years, the demand for EVs has significantly accelerated because the product itself is appealing. The price point, the design, the range, all of these factors, people want to own a Tesla now, not because of the societal benefits, but because the car itself is actually really attractive. Schroders just did a survey of 23,000 investors around the world. 47% invested sustainably because of the sustainable and social elements, 42% because of the perceived economic benefit. People are now looking at ESG and sustainable investing because they actually think going forward, it will deliver better returns. And rightly so, because of stranded assets and other elements. I think this is a tipping point for mass market shift in financial assets, because everyday investors are actually now going to make a decision about a product and invest sustainably because they like the product itself. Not just the social elements, not just the response to the survey. They're going, I actually think I'm going to make some money out of this. It's a great return. And look, if we're being blunt, if we're going to actually make change, we need everybody to come on board with us and get a line behind it. And I think to see surveys coming out now with those sort of signals that people are investing in products because of the returns and because of the product themselves, that's actually an interesting tipping point for the financial services space.
I do agree. When we do surveys and we see what people want to invest in, they not only want to invest in avoiding bad stuff, they want to invest in a positive future. And so there haven't been those products available in the past, and now increasingly there are. We need to close off soon, but Ronan, I just want to come back to you on one thing. Mercer's got a policy that you're going to decarbonize your portfolios as an investment provider over the next between now and 2050. So you are one of few funds in New Zealand. There are kind of 5 all told, and we're going to talk more about that at a seminar next week. But can you tell us a little bit about your thinking of doing this for the long term, because it's a big call to enter into a policy like that?
Yeah, so we've committed to net zero across all our portfolios in New Zealand by 2050. But more importantly, again, that idea by 2030, we've committed to 2030, targeting a 45% reduction by 2030. And the reason we say that is, backed up by science, backed up by our analysis. In order to hit net zero by 2050, you need to be doing a lot of the heavy lifting in the next 9 to 10 years. So unless you're hitting a 45% target reduction by 2030, you're not going to get to net zero by 2050. It's very easy for people in the investment community to make these things, commitments by 2050, when in reality, when 2050 comes around, a lot of those people will be retired and they can't be held to it. So we have certain commitments. How we go about addressing that is we built, and coming back to Dean, the comment about data and analytics. So how we think about it as a transition. So we built our own proprietary analysis where every single security, every single company in the portfolio, we're able to measure what we think their transition is over the next 1, 3, 5, 10 years to a low carbon world. So what that means is in one of our managers or underlying portfolios, you could have 6 companies that if they were 0.5% of the weight of the portfolio, they could be the lion's share of the carbon in the portfolio. So the question then is, why is the manager holding them in the portfolio? So they come back to engagement. So then our question goes to the manager, why are you holding these stocks? This is a systemic risk. It's not something that we as a firm believe in terms of we believe in sustainability and lower, and we're committed to this. So you need to think, let's have a conversation on why you're holding them. And then that itself fosters further engagement. How we think about it is it's not just about exclusions in the equity side of things. We believe in decarbonisation across all asset classes, but it's also a positive aspect to it as well. We believe that there will be a lot more climate solutions coming into portfolios. A lot of the infrastructure, as touched upon earlier on, will be more leading to decarbonisation. And it's true time with the energy transition as wind and solar and other energy, renewable energy come aboard, will be less and less of a need for fossil fuels. What's interesting is with the run-up in oil prices at the moment, you're beginning to see more and more focus on other renewable energies as well. The energy situation going on in Europe at the moment, the energy crisis, again, is another leg to push towards a lower carbon world. But just to say, like, this is imminent in terms of what we're doing. This is what we're actively doing in portfolios and what we've been looking at portfolios for the last decade in terms of lower carbon footprints.
Cool. So I think we have to wrap up there. We'd like to keep these seminars short and sharp. So thank you very much to the three of you, to Niamh O'Flynn from Greenpeace New Zealand, from Ronan McCabe from Mercer, and Dean Anderson from Kernel Wealth. That was a really interesting discussion. Thank you all very much. I thought your different perspectives brought things to life, and I'm glad we got into a few crunchy issues. For those of you who are listening, you can check out your fund information on Mindful Money's website, so you can have a look at the companies you're invested in, including fossil fuel companies, and you can ask the fund managers what they're doing about engagement, and that's the kind of dialogue that's really important for you to have in terms of taking your own responsibility for investing ethically, because you're not necessarily going to be in the fund that does it for you. And finally, to our earlier presentation, you can actually make a big difference to your climate footprint by taking care of your investment. It really does matter. So for tonight's event, we had some sponsors. So gold sponsors, AMP, Booster, Generate, KiwiSaver, and Harbour Asset Management. Thank you. And silver sponsors, KPMG, Mercer, Milford, Nico, Public Trust, Russell Investments, and Westpac. So we're grateful to our sponsors. And special thanks to you, our audience. Next week, we're coming at a different time. We're going to join with an organisation called Toitu Tahua, the Centre for Sustainable Finance. And we've got a lineup talking specifically around COP26 and about net zero. The lineup includes Laura Clark, who's the British ambassador to New Zealand, Adrian Orr, who's the governor of the Reserve Bank, Matt Winneray, who's head of the Super Fund, and others. So we're discussing what's going to happen at COP26, net zero, and the results of a survey that we just did across the largest fund managers in New Zealand. So all of that next seminar. So it's at 3 p.m. on Thursday, the 4th of November. It's all on our website. I think there's a button that you can click down there that says register for our next seminar. Please feel free to do so. It's all free. So I hope you join us next week. It'll be a really good event. But thank you very much to our panelists tonight and to you, the audience. Ka kite anō.